Thank you, Krishnaja. Uh, uh, please be, could you please share option is given? It's not available to me right now.
Yes, will be given right now. Please wait.
Yes, sir. So shall I start?
Yeah, you can start it.
Respected head of the department, Dr. Gabriel Simon Tuttle, all other teachers of the department, our seniors, my dear colleagues and my dear friends. This is Rehuma from MCom Finance and Accounting S3 here to present before you all Budget Analysis 2020 to 23, and the topic which is allotted to us is taxation. And here we have divided it into two parts, direct tax and indirect tax, of which the indirect tax portion shall be handled by me and direct tax shall be handled by Sri Lakshmi ji. We have already seen in the budget speech of our Honorable Finance Minister that the part B of the budget speech is exclusively meant for taxation. And moreover, our Honorable Finance Minister, apart from any other provisions relating to budget speech, has clearly mentioned or clearly started the budget speech by chanting the slogan number 11 from Mahabharata. Moreover, we know that taxation is the major source of revenue to government. And another important fact with regard to this is, as I have already told earlier, taxation is divided into direct tax and indirect tax, as against the usual customs of follow-up of indirect tax by indirect tax, follow-up of indirect tax from direct tax. We have made a change to that. We will be beginning with indirect tax for the reason that if we look into yes, this image that I have presented it right before you. You could see that almost 16% of the contribution to the government's revenue comes from GST, which is followed by direct tax of 15%. Moreover, no media or no newspapers has reported anything with regard to major changes that have made in made in direct indirect taxes apart from that of the custom duty change. So for this reason, we will be beginning with indirect taxes. And yes, coming to the indirect taxes portion, again, one important aspect with regard to this is, after the inception of GST in 2017, the country recorded the highest revenue from GST in the month of January 2022, which amounted to almost 1.40 lakh crores. And for this, our finance minister has congratulated each citizen of this country for making their valuable contribution to GST, irrespective of the exposure to which they are supposed to in the mid of pandemic. And let us move on to the amendments one by one. I will be beginning with the changes that are made in customs duty. And of course, a number of products, almost 350 items, which were not subjected to customs duty earlier in the previous year, will be now taxed. And moreover, the vision of Atmanirbhar Bharat, which will be held high, there are changes with regard to faceless customs as well as project import and capital goods, of which we will be looking into one by one. First of all, let us look into the items. These are the items with regard to which, the major items with regard to which customs duty has changed. There are a number of items of which customs duty have been changed. Here I will be mentioning those important ones. The first item coming under the electronic devices, you could see that almost these three items are there. And for this, you could see the import of this product as such from the international market has been increased, whereas the import of the input of these products is reducing. And coming to gems and jewelry sector, here also we could see that for the cut and polished diamonds, it is being reduced. For the imitation jewelry, it is rising. For MSME and chemicals, like umbrellas, it is increasing, and chemicals, it is reduced. But the major thing you have to consider here is the major proposals made by the state governments was regarding to the gold, but no mention was made with regard to gold. No duty exemption or nothing was given. And here, like the previous year, whenever a person has to import almost 1 kilogram of gold, I think he is have to pay 10.25 percentage of import duty for the same, and this will further increase the smuggling in the country. And coming to another important fact of custom reforms is under project imports and capital goods. So first of all, I would say what is project import? So there are some industrial projects in country of which inputs are imported from outside, specifically like mining. So in such cases, for import of such inputs, all such inputs are grouped into a category of which tax was not charged at all. And there are also the capital goods policy of 2016 that was aimed at doubling of production of capital goods in India. All these items have been from this budget 2020 to 23 will be taxed at 7.5 percentage. There is also a provision with regard to faceless customs. This means that we have already an IT-driven economy right now in digitalization at its core. So faceless customs is again emphasizing this. This means that we can clear the procedures in a port without having the face-to-face interaction between the officers. That means that every clearing procedure will be handled online. And again, these are all the amendments, major amendments with regard to custom duty, and the reforms I will be discussing, I have already discussed, and the implications of the same. We have already seen the different items, right? And all these products where their charges were reducing for the international import of all such products, and their inputs were demanding a reduction, and the products as such where their duties were rising and their inputs were reducing. So this means that the government is making a boost to Make in India initiative to promote the domestic industries of the country. That means there will be cost competitiveness because these companies could raise their inputs at a lower price, which result in low cost and at a price which is lower than other products. And there will be promotion of these industries, employment generation, and that further leads to the economic growth of country. And coming to the next point, that is faceless assessment that I've already spoken of. But there is the advantage is that the undue delay that we face at the port can be minimized, and the country will be able to raise more import duty as well because less officers are required. Everything is online, so an officer sitting in Chennai or even Cochin can handle the port procedures of Mumbai. So this will enable the government to rise more revenue. But there is a small impact. A negative side of it is that the custom brokers who acted as the intermediaries was going to suffer because they might lose their jobs. And coming to the next aspect, which is excise duty, an interesting aspect, because we are for the past 4 or 5 months we have been facing a rise in the fuel prices. We could expect this, we could make an expectation that this might lead to reduce in fuel prices because there is something like blended fuel. Blended fuel means that all the petroleum products or the diesel products that we use in our cars or other motor vehicles, these products can be blended with the ethanol that we rise from the sugar industries of the country as well as from the I think from agriculture sector, other agriculture sector as well. So the benefit is that this is a naturally occurring product, ethanol. So when we mix it with this petroleum products, the gross emission of carbon dioxide will be reduced, which further paves way for a reduction in global warming as well. And another important fact with regarding to this is for this reason, the unblended fuel shall attract an additional excise duty of rupees 2 per liter. This means that this blended fuel, it is in one way it is a very good initiative taken by the government because we will be having an eco-friendly product. Moreover, the sugar industries, as I have mentioned earlier, will be having a high net worth in the share markets as well as their business goes on improving, and the outflow foreign exchange can be saved. This is a funny fact. I could say, like, if we are importing, if we are in need of 100 barrels of crude oil or any other product with regard to petroleum industry, what we need is 90% of the petroleum product is required. The remaining 10 means 8.5 is the precise measure. 8.5% we can add is the ethanol. So this only 90% of the fuel demand of the country is to be imported. 10% is available in our country itself. So we could, the oil import will reduce this, and thus we will be able to save the outflow foreign exchange as well. And this is with regard to excise duty and its implication. And this factor that I'm going to discuss here is input tax credit. This thing is what I have told earlier. I haven't read it in any newspaper unless I have searched for it in various YouTube channels and all. This is the thing that is going to have a major impact on the GST payers of the country, because input. First of all, I will say what is input tax credit. Suppose you are a manufacturer and you have an output. You sold it out to a consumer. You have received GST from the consumer as well. So after that, what you do? You have to pay. You have already paid the input taxes for the inputs to your supplier before. So what the practice is, you will not be you are not required to pay the amount other than the additional tax that you have received from the consumer to the supplier, which will be further lended to the government. But this is the very backbone with which GST was introduced in India. And this introduction time, there were four conditions that are to be satisfied to ensure the seamless flow of credit. It was assured that there will be a seamless flow of credit to the country's citizens who are paying GST, especially to the purchasers and the retailers. But these four conditions, apart from these four conditions, on January 2022, the government put forward with the fifth condition, that is with regard to there should not be any mismatch between the GSTR1 and GSTR3B of the buyer. And here, with the budget 2022-23, another important condition has been put forward, that is with regard to compliance with the Section 38. And I will sum up all these things with an example. Consider that you are a purchaser. You are a producer of a capital good, and for that you have to import several inputs like steel, screws, tires, etc. And at the time of purchase of the inputs itself, you have paid the GST. Let us assume it be 12%, and the input cost almost around 100. So the GST what is required is 12 rupees, and you have manufactured the product. You have sold it out not at 100 rupees, at 150. The 50 is the value addition. Again, 12% GST you have to charge it from the consumers. That is 15%, and that amounts to 18 rupees. And the difference, 6 rupees is only you have to pay it back to the supplier. That means the 12 rupees, 18 minus 6, 12 rupees that we have availed from the consumer is your credit. But after the introduction of the fifth condition, or all these conditions is making this process complicated. There will not be seamless flow of credit now, because if the supplier makes any mistake, the mistake in the sense in filing the return, in paying the tax, or a difference in GSTR1 and GSTR3B, this is going to impact not the supplier but me, who is the taxpayer. This is not fair in my point of view. This cannot be accepted at all, because there are a number of taxpayers who are innocent in the country, and this burden of the default of the supply cannot be put into their head. So the implication is that the vendor or the supplier would cost the taxpayer's business. And of course, that I've already discussed. Then time consumption. If I have to look for whether my supplier has complied with his provisions, whether he has filed the return, whether all the facts of supplier is now on my head, and impact of the working capital. Yes, that is another point, because I will be subjected to double taxation. I have to pay GST if my supplier defaults. This is all with regard to input tax. Additional condition. Next, with regard to input tax credit, is extension of due date for availing ITC. This means that earlier it was on October 20th for the last date. Now it is extended to 30th November. It is a good measure, because we will have time to check for whether the supplier has made his compliance or not. And coming up with the implication that I've already discussed, this is a good measure. And now there is another provision with regard to ITC, that is wrongly availed credit. That means if I have wrongly availed an input tax credit which was not actually available to me, and even if I haven't utilized it, I was subjected to repay it back to the government or reverse my credit. So this was the provision earlier existed. 18% was the charge for that. Actually, it is interest, right? Okay. And after that, the government has made up many provisions, or many people speak up against that, and as a result, this was reframed as such. Now people will be have to charge interest, or will be charged interest only for the credit that they have availed but utilized. This is a good measure, because we will be relieved from paying interest for the credit that has not been utilized. And coming to this, with regard to cancellation of GST registration, previously, if I made a default in filing of returns for consecutive 6 months only, my GST registration will get cancelled. But now this is not the condition, because now if I haven't filed my GST within 3 months, I will be subjected to cancellation of my GST right or GST registration, which will have a legal impact on my business. This is not acceptable, because especially during the COVID pandemic, a large number of composite taxpayers in the country don't have a full-time accountant with them. If the accountant they have is having with some issues, some health issues, they will lose their GST registration, and this is not acceptable. And coming on with the amendments that are made on cess. Says fully IT-driven measures are taken with regard to customs administration. And another important fact with regard to cess is that a new legislation is going to replace the Cess Act of 2005. And the implication I could say is, it, as I have already spoken up with regard to customs. Faceless customs, here also there will be ease of doing business, and the sunset clause effect is eroded off. Sunset clause means, we have studied in income tax that for the first 5 years, for the cess industries belonging to the cess will not be need to provide income tax for the first 5 years, and certain other exemptions as well for the first 15 years. So this won't be available. This was available only up to 30th September 2020, and in order to erode off its effect, there will be a cess new act, and this is a welcome measure. And this is the concluding points of what I have already spoken of. With regard to customs, there is a beneficial actions that are all made. The amendments are all beneficial to the economy. To the excise with regarding to blended fuel is also beneficial. But the additional condition of ITC is detrimental, and there should be some measures, right, to overcome that. In my point of view, I could say that there should be a legal aspect, a legal binding effect, means to support the taxpayers, that they could file a case against the supplier if they make a default, and as such. And an indemnity clause could add it as well. And there are some other measures, like we could train the vendor, we could train the supplier, making him understand the importance of complying with the tax procedures. And extension of time under ITC, again a welcome measure. Wrongly availed credit, we have spoken from 18% to 24%. Though it was a rise, it is beneficial to the economy. Cancellation of GST registration is not at all acceptable, especially in the scenario, and cess act is beneficial. With this, we are coming to an end to the amendments which are made in GST and the indirect taxes. I hope it is clear. Now we will be moving on with the direct tax presentation, which will be handled by Sri Lakshmi. So over to her. Thank you.
Yeah, it's visible. You can start.
Okay, sir. Good evening to all of you. My name is Sri Lakshmi Ji, and I'm from MCom Finance and Accounting, Semester 3. I'm here to present before you the next part of our analysis. The indirect taxation key proposals and their possible effect of the Union Budget 22-23 has been analyzed in detail by Rahma, and we are now moving on to the topic direct taxation, the key provisions and their implications. So the first and foremost thing to be noted is that the tax slabs and rates remain the same for the majority, except some, like the persons with disabilities, state employees, and virtual digital asset investors. So no populist measures have been taken in respect of personal income tax. This is beneficial also, but also this comes as a disappointment to many, especially the salaried and middle class, who were expecting some kind of a relief from either by changes in slabs or by rate reductions or increase in the limit of the tax deductions. So also when there is a need for stimulating domestic demand and inflation in the economy, usually it expects a raise in the income tax slab limits. But some provisions are there. Like I said earlier, we can now look into that. Changes in tax for individuals. The first one is related to COVID. So it is a provision actually enacted to give effect to earlier announcements made by the government. So taxability of COVID-19 assistance to the affected and the ex gratia payment for the family of the deceased from the employer or any other person. So it has great importance considering the health contingency that our country is currently going through. So here we can see that two components are there. First is assistance, which is provided to the affected for treatment, for the medical treatment of COVID. So if any such amount is paid to the employee from employer or by any other person, the whole of the amount will be exempt from tax. And if any ex gratia payment is paid to the family of the deceased, then if it is paid by employer, it will be fully exempt in the hands of recipient. But if it is paid by any other person, the exemption limit will only be up to 10 lakhs, and above 10 lakhs, it will be held as taxable. The next provision is with regard to long-term capital gains. So the LTCG surcharge for all assets is fixed at 15%. So here it implies that only certain assets were having 15% before that. So these are explained in detail in later slides. Next is the tax deduction limit on employers' contribution to NPS account of state government employees to 14% under Section 80 CCD subsection 2. Employer, here the employer is the government. It may be central government or state. Employer's contribution towards national pension system, it is eligible for tax deduction. Now it is 14% of salary for central government employees and 10% for others. These others may be state employees as well as other private employees. Out of this 10% limit for state government employees, it is proposed to raise this 10% to 14%. This is done with a view to bring it into parity with the deduction allowed to the central government employees. So again, this would apply retrospectively from 1st April 2020, and the state government employees can claim this higher deduction even for 2020-21 by filing revised returns. One thing to note is that there is no change in this for private sector employees under the corporate NPS model. Next is the tax relief given to persons with disabilities. So as per Section 80DD, if an amount is paid or deposited by a parent or guardian of a disabled dependent under any insurance scheme, it is eligible for deduction. So the present law provides for deduction to the subscriber only if the lump sum payment or annuity is available to the differently abled person on the death of the subscriber, in this case, parent or guardian. The budget now proposes to the payment of annuity and lump sum amount to the differently able dependent during the lifetime of the parents or guardian. So it is so proposed because the differently able may sometimes need the amount even during the lifetime of the subscriber. So it is again a beneficial measure. Next is with regard to tax on virtual digital assets. So with regard to the VDAs, government has given two major proposals. The first is to introduce a central bank digital currency. It is expected to contribute to the digital economy and to a more efficient and cheaper currency management system. And this will be issued by RBI, and this digital rupee would be based on blockchain and other related technologies. The second proposal is to bring the virtual digital assets into the tax net at the rate of 30%. So as VDAs were the main topic of discussion yesterday also, but it is also one among the major reforms of taxation. I would like to quickly go through the taxation aspects and its impact. Income tax rate flat 30%. So if the surcharge and cess is considered, this would totally, the effective tax rate would come between 34 to 42.7%. And this is with effect from 1st April 2022. Then no deduction in respect of any expenditure or elements except cost of acquisition would be given. Loss cannot be set off against any other income and cannot be carried forward. So here we can see that it is considered like speculative profits. But whether the loss from virtual digital assets can be adjusted with the profits from other virtual digital assets, it is yet to gain clarity. Next is with the objective to capture the transaction details, a TDS of 1% of the consideration on payment related to transfer of VDAs. When such transfer is above a monetary threshold is also introduced, and this will come into effect on July 1st, 2022. Gift of VDAs to be taxed in the hands of the recipient. So the implications this taxation regime has given, it has definitely added added a revenue stream to the government. But what we can arrive at is that by some kind, the government is also accepting or acknowledging the crypto assets, the digital assets, but they are not legalized yet. Also, in the previous year, there was a bill proposing an outright ban on the cryptocurrency, but with the introduction of a taxation system on these digital assets, the fear of an outright ban is also lifted. The next thing is, it is not legalized yet, but it gives a kind of recognition to these virtual digital assets. Again, the scope of this is confined to merely assets, but in virtual form. Also, the high taxes could lead to shift to equity markets, though it is kind of a punitive taxation. Like they are taxing it at 30%, and TDS is also there. So this could attract more and more investors to stock and equity markets. So with regard to this virtual digital assets, the government is going with a balanced approach. They are not the taxing of these can be seen as a first step towards recognizing crypto, but they may not be given the title of currency, as already they are confined to mere assets. Still, the implication that we get from the budget is that an outright ban would not be there, but still accepting it as a legal tender has very low chances as of now. So what will happen to the value and investment in these virtual digital assets is yet to be seen. Next provision is with regard to surcharge. Surcharge on LTCG arising on transfer of any type of assets capped at 15%. So like I said earlier, currently total income includes any income chargeable under section 111A and 112A. Then surcharge in respect of that part of income is 15%. This is applicable for assets like listed equity shares, units of equity-oriented funds, or units of a business trust, and also those having income below certain threshold limit. For other LTCGs, the rate can go up to 25% or 37% on tax. Now, this has been extended. This 15% has been extended to assets of all nature. This will be most beneficial to those taxpayers falling in income bracket of more than 2 crore. Because for most of the time, those having income more than 2 crore are attracting more rate of surcharge. So this will be beneficial for those. Next is surcharge of AOPs, consortium formed to execute a contract capped at 15%. So in certain circumstances, or as per terms and conditions of certain contracts or certain work, it may require the formation of a consortium where the members will be companies. So then it will be association of persons. For an AOP, the surcharge rates are similar to individuals in HUF. It can range up to 37%, like we said earlier. This amount is much higher than that of individual companies. So to reduce this disparity in surcharge between individual companies and AOPs, and in general to provide a boost to the startup community, this surcharge on AOPs have been capped at 15%. Next is the withdrawal of the concessional 15% tax rate in respect of dividends earned from foreign subsidiaries under Section 115 BBD. So Indian corporates, the companies benefited from a lower tax on dividends of almost 15% received from a specified foreign company. When this dividend is from a specified foreign company, it is a company where shareholding is 26% or more. So this concessional tax has been withdrawn. This is justified by stating that earlier removal of dividend distribution tax. So it will compensate to that. Such dividends will now be taxed at normal rates then. The lower rate, which was there already or just there now, is an incentive to bring back the cash to India. So now this incentive has been withdrawn for the corporates. Next is the incentives for business. Mostly there are some date extensions and some reduction in tax surcharge and AMT. So we can look at those two. First one is for startups. With regard to startups, there is a scheme. The eligible startups incorporated before March 31st, 2022. It usually gets a tax holiday incentive of means they will get 100% deduction of profits and gains derived from their business for 3 consecutive years out of 10 years from incorporation under Section 80 IAC. This is extended for 1 year. They're mostly citing reasons like COVID and the related delay in setting up such units. So, startups established up to March 31st, 2023, instead of March 31st, 2022, will now be eligible for tax relief. Generally, the startup ecosystem in the country is going higher with increasing job opportunities and tax benefits and investments. So also we can see that record numbers hitting the unicorn status over the last 24 months. As per the economic survey, out of the 83 unicorns, total unicorns in India, 44 Indian startups have achieved unicorn status in 2021. India is also now the third largest startup ecosystem in the world after US and China. So the extension of these tax benefits is expected to further strengthen the startup and business ecosystem of the country. Next is the concessional regime for newly incorporated business domestic manufacturing companies under Section 115 BAB. So for those companies which are domestic and they are manufacturing in India. So for those companies, if they are incorporated until March 31st, 2023, they are eligible for a lower tax rate of 15%. So it was in September 2019, this was announced. So the government then had said that any new domestic company incorporated on or after October 1, 2019, if they are making any investment in manufacturing, any would have an option to pay income tax at the rate of 15%. But they have to commence their production before March 31st, 2023. Also, these companies will not be allowed to avail any other tax exemption or incentive, and they also is exempted from payment of MAT. So this last date has been extended by 1 year to March 31st, 2024. So this will is expected to provide a boost for new domestic companies to set up their manufacturing units in India at a faster rate. Next is regarding cooperative societies. So it is also to be noted that this is the first budget after the formation of a separate Ministry of Cooperation. The first measure is reduction of the AMT from 18.5% to 15% and reduction of surcharge from 12% to 7%. So the alternate minimum tax for cooperative societies, currently they are required to pay at the rate of 18.5%. However, the companies, they have to pay the same amount as MAT at the rate of 15%. So the cooperative societies should also get benefit from this. So this reduction to 15% will eliminate the disparity between tax of cooperative societies and companies. Next is the reduction of surcharge from 12% to 7%. This is applicable for those cooperatives that have income of more than 1 crore but up to 10 crore. So now the rate of surcharge is at 12% if income exceeds 1 crore. So it is inferred that if it is available to cooperative societies uh, with income between 1 crore and 10 crore, then this reduction in surcharge will benefit those having income between 1 crore and 10 crore. So we can say that if it is above 10 crore, then 12% will continue. So this all these reductions will help in enhancing the income of cooperative societies and members, and the most of these members are from the rural and from farming communities. So it will be helpful for them also. Next are some measures in relation with voluntary tax compliance and easier tax payment and administration, building such a system. So it is more on the procedural side. The first step in this is provision to file an updated return. So this will enable the taxpayers. Normally, there is a issue from the taxpayer side that there is no enough time for filing of revised return. So this will enable the taxpayers to update their returns beyond the now existing short time limits. So now they can do this only before 3 months prior to the end of relevant assessment year, or before the completion of the assessment, whichever comes first. But now it is proposed to enable this filing of not a revised return but an updated return up to 2 years from the end of assessment year. And it will also attract the taxpayer has to pay an additional tax of 25% or 50%. So this 25% or 50% will depend upon the time frame within which the taxpayer is filing his updated return. If it is within 1 year from the end of assessment year, 25% will be there. And if it is between 1 and 2 years, 50% will be there. And this 25 or 50% is on the aggregate amount of tax and interest due on the additional income declared in the updated return. So now we can see the implications of this. This has also been highlighted as one of the most important tax proposals. So this will provide an opportunity for the taxpayer for a more comprehensive reporting, and it will help in voluntary tax compliance. This will help the taxpayers. This will give them an opportunity to address any unintentional or accidental errors, any omissions or mistakes that they have made, and eliminating complex and time-consuming litigation process. Normally, if the department finds that some income has been missed, then the process of adjudication is quite lengthy. So this can be avoided by this. Another major concern with regard to this is that we have to pay an additional tax of about 25% to 50%. So this payment of additional tax at a higher rate, this is also it is not it is questioning whether the success, whether this will go on with the objective that they have proposed, that is increased tax compliance. So it is not encouraging to file return after due date, but it is more on the voluntary tax compliance side. There are also certain exceptions that the updated return cannot be filed if there is loss or reduction in tax liability or it result in some refund. Next is better litigation management. So if a question of law, in case if an appeal is pending and another appeal which is similar to the pending appeal is filed, then is filed before the jurisdictional high court or supreme court in any case, the file of further appeal by the department shall be deferred till the appeal is decided by the jurisdictional high court or supreme court. So this measure has been taken to avoid repetitive litigations or appeals between the department and the taxpayers. Next is deterrence against a tax evasion. No set off of any loss shall be allowed against undisclosed income. Deterrence among tax. The aim is to bring deterrence among the tax evaders. So any undisclosed income is detected during search and survey operations. No set off of any loss shall be allowed against them. So this is done by inserting a new section 79A, and this will come into effect on 1st April 2022. This is because it is observed that set-off is seen in many cases to avoid tax payment when there is undisclosed income or suppression of sales. So this step will increase deterrence among tax evaders. Next, we have come to the final part, that is the positives and negatives regarding taxation. So the positives we could identify was reduction in surcharge, focus on economy needs, COVID-related tax relief. It is also beneficial. Relief for state employees and persons with disabilities. They are gaining an incentive for startups. The incentive provided for startups, new domestic manufacturing companies, cooperative societies. These incentives are also beneficial. Then regarding virtual digital assets, there has been an acknowledgement from part of government. High taxes on virtual digital assets. Like I earlier said, this can attract more and more people to stock market. Voluntary compliance measures and tax administration measures. And with regard to negatives, the negatives we could identify was withdrawal of the concessional 15% rate available in respect of dividends earned from foreign subsidiaries. This was discussed in the previous slide, no new major tax relief for individuals. Then high taxes on virtual digital assets. It is like the government is discouraging, and it is kind of a punitive taxation. So this is also a negative. Payment of additional tax at a higher rate for updated return. So this will also it will hinder the objective with which the updated return is introduced. So with this, the analysis of all the major taxation policies proposed under the union budget is completed. Thank you to all of you.
Okay, so thank you both Sri Lakshmi for your presentation. Went well, but only thing is you took a long time. I think beyond what is allowed for you. But anyway, before I come into my comments, there are others who want to raise anything, the participants. Any discussion points which you would like to?
No, sir. I think all the points they have touched upon.
Okay, I'll just
Such an elaborate explanation and very beautifully constructed slides.
go into one or two things. Like the first indirect part was actually discussing the implications of the GST, more specifically input tax. And I think Sri Lakshmi talked about the input tax conditions as a negative point, along with the cancellation of GST and other points as the positive one. So they were talking about positive, negative, and implications also. So also the direct tax, including ATDD, alternate minimum tax, COVID-related tax relief, the national pension scheme, all those things have been covered. So I think that has been done well. So because we are running short of time, we will go into the next group. Next group is from GBO, right?
Krishnaja, yeah, Krishnaja, yeah.
Next, I call upon Group 4, MCom Global Business Operation, to present on the topic International Trade, Corporate Sector, and Policies on Financial Services. And the panelists are Ms. Bhagilakshmi J, Mr. Ajim Shah MJ, Ms. Shruti SB, Ms. Jubra JJ, and Mr. Ashfaq N. Over to the presenters.
Thank you, Krishnaja. Am I audible?
Yes, you are audible.
Thank you, sir.
Nehit, can you give that share option?
Yeah, will be done now.
Is my screen visible, sir?
Visible.